Hello, welcome everyone to another video of your Mere Finance, your financial markets analysis channel. So today we're going to talk about how to invest in commodities because in the last years we have seen commodities constantly in the news. Actually, orange juice has been the best performed asset in the world this year. So it's always good to know how to invest in commodities. So today we're going to talk about what the commodities are and how we can invest. So before that, don't forget to subscribe. So today we're going to talk about really how the commodities market work, because as we can see, people think that buying commodities is basically buying the physical product. So if you're buying oil, you have to buy the oil and store it in your place. Or how are you going to trade it? Because it's not as easy as trading stocks and bonds where you just call a broker and they just buy it for you. For the commodities market, it's a little more regulated and complex. So today we're not going to talk about the dynamics of the commodities market, but we're going to talk about how to invest from an index perspective. So an index is basically a financial product that invests on your behalf. So you're basically buying a fund. So if you can see the S&P 500 here, it's up 290%, and we're going to analyze all the commodities indices that are broadly used in the market. You can see the LIAG, which is the lower bluish line, like light blue, is down 14% for the last 10 years. This is comprised of all the bonds in the market, all the fixed income assets in the market. So like mortgages, ABS, bonds. It's a different index that holds all of them. So you can see that commodities usually tend to, outperform a bit the fixed income market, at least lately, but underperform stocks. But we're going to talk about the different commodities. You can see RICI is up 27%, while the S&P Goldman Sachs is all only 9.7%. And why? Well, let's see. Let's see how they are built and they are constructed differently. So the first one we're going to talk is the oldest one, is the Refinitiv Core Commodities CRB Index, which was called actually the Reuters CRB Futures Price Index, and it began in 1956, and it has been readjusted 9 times until 1995 to reflect market structure and activity. So the index featured back then until 1995, before Reuters took over, around 17 components, all equally weighted. So you can see here from crude oil to sugar, orange juice, coffee, cocoa, live cattle. I don't think the methodology works here. Why? Because basically you cannot have like an equal weighted component. It's impossible that markets actually move by the same amount or utilize the same amount of crude oil or heating oil than they use for cotton. Like you cannot have an index that has all these components being equally weighted. So I don't think this is useful. Nowadays, it's actually 19 components and energy is capped at 33%. So the first graph that we showed was actually in the 1990s, and currently this is the components of it, 19 components, energy cap at 33%, but you can see they're almost equally weighted from heating oil to gasoline, natural gas, corn, soybeans, cattle. The only ones that change are nickel, lead, lean hogs, orange juice, and silver, which 1%, and then crude oil. So again, I don't think this is a good methodology because you cannot like just have equally weighted for every component except crude oil. So we don't like that one. Then we go to the Goldman Sachs Commodity Index. So they are weighted accordingly towards production. So basically on the 5 last years, how commodities demand and supply has been looked into it. This is really hard. There is not much methodology. The methodology in the websites is not helpful because they basically have like a sub indices, and each indices have a different methodology. So this is the aggregate of all the indices, and you cannot see like individual weights. You can just see like by sector. So in this one, energy is at 57%. We presume is heating oil, natural gas, and crude oil. Then we have livestock, agriculture, precious metals, and industrial metals. The thing that we don't like about this one is that it goes depend on the price. So this one is mostly about price. So if the price goes up, then you put a higher weight on that indices. You don't actually reset it really. So it's basically, it's not helping you because as prices go up, of course returns will go down, right? Unless they keep going up. So we don't like this because it's not usually reset or adjust. It's just based on the prices. So then we have another one is the Bloomberg. Oh, forgot the G there. The Bloomberg Commodity Index, which was launched in 1998, is widely tracked benchmark for the commodities market. And now the index has around 100 billion, which is the highest level on record, and the index references exchange trade contracts of 23 physical commodities. So we saw the first two, one was 19, and the Goldman Sachs we actually don't know because it's quite hard to find the methodology. So the Bloomberg is it's 23, and here energy again all the way up to 29%, grains 22, industrial metals 16, 15.4, precious metals almost 20%, softs like sugar, coffee, cotton 7%, and livestock 5%. So this one we like it, constantly changing the target weights, doesn't depend on the price. Energy is capped at 33%, very diversified. So it's a good one, and that's also why this one is the biggest index used across the market with 100 billions of assets under management. So it's a good one because it's has a lot of the components, it constantly changes, and the methodology is correct. But the one that we are interested in the most is the Rogers International Commodity Index. So this is a broad index of commodity futures designed by Jim Rogers in 1996 and 1997. He wrote a book called Hot Commodities. Jim Rogers is also famous because he co-partnered with George Soros in the Quantum Fund and was a hell of a investment manager. So he has a lot of good credibility. So this is a broad-based international vehicle, and the index tracks 38 commodity futures contracts for 13 international exchanges, and the weight changes on a daily basis. We saw in the first graph that this index outperforms the rest of them, and it's because he was frustrated, Jim Rogers was frustrated that all of the indices that he saw in the 90s were not were not built in the way he wanted. That we see some had like equally weighted, other depends just on the price, and mostly was just tilt to oil or to energy commodities. So he really studied and he really created like a very diversified and good methodology for his own index. So this is 2004 on the right side. You can see crude oil at 35%. Nowadays it's 15%, and you can see soybean and wool, silk, palladium, which are components that are not in the other indices. So you can see even milk is part of these different types of wheat, sugar, rubber, cocoa, gas oil, coffee, lead. So it's a really comprehensive one. So the ticker is RICI. We are not here saying that you should buy it. We are just saying it's the best in terms of building methodology and diversification. So let us know what you think. We are going to keep reviewing. We are going to go into the RICI, the Rogers International Commodity Index next video to really understand what's within it, the methodology, and then we're going to start actually talking about how the futures market in the commodity space works. So don't forget to subscribe, stay tuned, I will have you more of the commodity market here at Mir Finance. So take care in this week.